Hello everyone and welcome back to PFJ. Today we'll talk about retirement accounts. This will be step 2 in our series about the basics of personal finance. But before we can talk about personal finance, I want to touch base on a general investment account. A retirement account is a type of an investment account, so it's important to talk about what an investment account is. In an investment account, you take your money, you put it into a general account of some sort somewhere, and then over time, that account gets bigger. And that envelope gets a little bit thicker and thicker. This might take 2 years, 5 years, 10 years. And then at the end of this, you get the money. Woohoo! This is a general investment account. An investment account is just a place to put money so that it can grow in that account. Now, the thing missing from this is taxes, because you're earning money, so you do have to pay taxes. In this equation, we have taxes here that come in the form of salary, and then we have taxes here when you take that money out. Now, you're paying taxes in essentially two different ways to simplify things. You're paying taxes when you put the money into the account, and you're paying taxes on the growth of the account. Both places, you're essentially making money. In a general investment account, this is how it works. You take your salary, you put into an account, that account grows, and as you take that money out, you pay taxes on it, and that's that. In a retirement account, which is a specialized form of investment account, you get break from one of these taxes. This was set up some time ago by the US government to make people save for retirement, as people were not doing it. So basically, they give you a break either when you put the money into the account, a tax break, or they give you a tax break on the growth of the account. Now, we should name these accounts to help us see how this works. There's two types of tax breaks. If you have to pay taxes before you put the money into the account, we'll call these post-tax. Now that's because you pay the tax first through your salary and then you put the money into the account. The other kind are the opposite of that, which would be pre-tax. Now in this, you put the money first into the account and then you pay taxes. Now, what kind of taxes are we saving here? In a post-tax account, you're basically paying the salary first, and then you're putting the money into the account. So you pay these taxes, but then you don't pay taxes on the growth of the account. That's super duper important to understand, that you pay taxes up front so that you don't have to pay taxes later on. All the growth on that money is tax-free. On the other side of this equation, in a pre-tax account, you don't pay taxes up front, but then you pay taxes on the whole of that account. And again, that is super important to understand the difference between the accounts so you can make good choices about your personal finance. Now, you might think that post-tax accounts are definitely better because of this, because you have less money here and then you would have more money here, and you'd rather pay taxes on the less money rather than the more money. I understand that, but there's also places to use pre-tax accounts. Now, why have all of these different accounts, and why don't people just use these accounts as their general way of investing? And that's because there's limits on these accounts. So for pre-tax accounts, usually you can only put in about $6,000 to $7,000 a year. This changes every year based on inflation. So every year or every other year, this increases by about $500. For a pre-tax account, you can put in about $19,000 to $20,000. Same thing here, it changes year to year by inflation. The other part of this is they're both age protected, meaning once you put the money into the account, it's hard to take the money out before a certain age. For both of these accounts, this is, I think, 59 and a half, so we'll call them 59 to 60 years old. Now, you can take money out of this account early on, but you just have to pay a penalty when you do that. So this is a general overview of what is a post-tax and a pre-tax account. Both of them, you're saving taxes in one way, shape, or form. This is a super important topic to understand. A lot of our talks will be based on what is post-tax and what is pre-tax. And as we go forward with this lecture, we'll define more terms such as what is a Roth in this category or what is a 401k with these categories. So it's important to understand these topics now. Now, as we talk about pre-tax and post-tax, I want to run you guys through a logistics of how a pre-tax and a post-tax account work. So in a post-tax account, you basically have your salary. You put this into an account somewhere, and we'll talk about where you can set up these accounts and how to actually physically go through the steps of it. But you have an account, you put it in the money, and it grows after some time, and then you take the money out. Since you're using your salary, those taxes have already been taken out by your employer. Now, in the pre-tax world, it's a little bit different. Usually, pre-tax accounts are set up by your employer. Now, if you are self-employed, you can do this yourself, but you have to still set up an employer account. It's simple to do, but it just takes some time to do. In this video, we'll mainly talk about the employer account. The employer takes your salary essentially before they pay them to you, and they help put this into an account. And again, we'll talk about the different types of accounts. They kind of are the same on the other side. And then you get your salary. Now, the one other perk of this pre-tax account is because your money is taken out before, your income is a tad bit less than it would have been over here. So as a result, you pay a little bit less taxes because you're making a little bit less money. And that's what we were talking about previously about having to not pay taxes on your salary. Now, the other perk of pre-tax or employer-sponsored accounts is something called employer matching. Employer matching, in essence, is basically that if you put in a certain amount of money into the account, your employer will match it and put a percentage of that amount into the account as well. So these usually range from 2 to 6%. Sometimes they can be a bit more. But essentially, if you put in $100, the employer will put in $2 to $6. And this is essentially free money. So this is something that you should definitely do. Otherwise, you're just leaving money on the table. Now, this also has a cap on it, meaning you can't put $19,000, $20,000 into the account and expect them to pay $2 to $6,000. But good idea here is just to meet it up to the cap, and then you're good. Now, we talked a little bit about investment accounts, and we talked a little bit about pre-tax accounts and what's a post-tax account. Now, I want to talk a little bit about terminology. There's a lot of terminology here associated with these accounts that's very oftenly misused, and that sometimes can hinder how you understand some of these topics. So I want to talk about some of this terminology to set it straight. We'll kind of start with how we did before with post-tax accounts, and then we'll have pre-tax accounts. So another way to say a post-tax account is to call it Roth. Another way to say a pre-tax account is to call it traditional. Now, a lot of people use 401ks here. That is not what it is known as. It is known as traditional. Most of those are usually called traditional 401ks, but we focus on the 401k. The 401k, where it fits in, is if it is employer sponsored. And most pre-tax accounts essentially end up being. So these is where 401k will be. Now, if it is set by yourself, meaning if you're self-employed and you don't have an employer, then you do it self. And those things are called IRAs, or individual retirement accounts. And you can match the up here to down here as you want. So you can have IRAs that are traditional, meaning that's a pre-tax IRA. You can have an IRA that's a Roth, So that's a post-tax IRA, meaning you pay your taxes first and then you put it into the account. You can also have traditional 401ks. Now, this is what most people know. This is your employer start this up. They call it a traditional 401k and then you pay money into it. You can also have a Roth 401k. Now, this is less heard of unless you set it up essentially yourself, because in this one, you have to pay taxes first and then you put it into the retirement account. But that's a general overview of what is a pre-tax and a post-tax account. Now, we talked about what is an investment account. You have your money, you put it into the account, it grows, and then you're good. We talked about how retirement accounts is a form of investment account, and retirement accounts save you money in one way, shape, or form. In a post-tax account, you pay taxes first and then you put it in the account. That way, you don't have to pay taxes on the growth of the account. On the other side, on pre-tax accounts, you have to put the money into the account first and then you pay taxes. So you pay the tax on the growth of the account. We talked about limits and age settings and how a general post-tax and pre-tax logistically works. If you have employer matching and your employer does offer that, then you definitely should do it. We talked about nomenclature, that post-tax accounts are called Roth, pre-tax accounts are called traditional. Either of these accounts, you can set it up by yourself or have someone else set it up for you, like an employer. When it's set up by an employer, it's usually called a 401k. So you have a Roth 401k or you can have a traditional 401k. When you set it up yourself, it's called an IRA or an individual retirement account. And you can have a Roth IRA or a traditional IRA. I hope you liked this video. I hope you got something educational out of this. If you did, please like, share, and subscribe. I'm going to put the notes up for free on my website. It's called pfjourney.com. Have a good one.